What's up guys, Sam Razban-Nia, the fitness accountant here. I'm here at Self-Made Training Facility in Long Beach. We're just about to give a tax talk to all the personal trainers here, and let's get it. What's going on everybody? I'm Sam Razban-Nia. I am the fitness accountant, trademark ding. Right now I assist business owners and entrepreneurs with all of their tax and accounting needs. I service a variety of industries, but my main focus is the health and fitness industry. And the main quick reason behind that is fitness changed my life, and I thought it made sense to give back. I just really love this world. You guys help people day in and day out, get them healthy, live the right life, and I think that's a beautiful thing. Changed mine, so I thought it made sense to help personal trainers and gym owners. And right now, as of just a couple weeks ago, I have delved into the world of bodybuilding. So I have Olympians now as clients as well. So yeah, I'm trying to, push in this industry. I love it. Today's tax talk is about a slew of subjects, but ones that are really important for contractors like y'all to know. The biggest thing that I want to start off with is what an independent contractor is versus an employee and what that means when it comes to taxation. So there's so many ways in tax law to describe an independent contractor. So some people are called gig workers, some are called freelancers, some are called sole proprietors. These are all ways to say the same exact thing, which in tax law comes down to what we file for you guys called the Schedule C. So, Adam has contracted with all of you as independent contractors. You guys are not employees. So you could choose your hours, you could choose your clients, and you have full range. That's what a contractor is. Now, in tax law, a Schedule C is what all contractors file. And this is called a sole proprietor schedule. So with this, it's essentially an income statement. And that leads me to a couple of terms that I want to talk about, which is income statement and gross revenue and profit. In accounting, we put profit as a pie. So just some terms that I want to go over so people have an understanding. An income statement is basically a profit and loss statement. And what it shows is how much revenue you've created, all the deductions and expenses that exist that pertain to your business. And at the end, that shows your profit, your net profit. That's what a P&L is, if you've ever heard of a P&L or an income statement. So the gross revenue is going to be what we call the top line. All the money that you've brought in from your independent training and anything that has to do with that. Then you have all your deductions, and then you have your net profit. So the way that a Schedule C is filed with the IRS is there's a form called the 1040. So the 1040 is going to be our personal tax return that we file every single year with the IRS. So the 1040, and then because we're all in California, there's the 540. So we have two tax returns. And then the Schedule C is going to be where all your income and expenses from your personal training go that then eventually flows to the 1040. So this is a separate schedule. So Benny's business, he's going to file a Schedule C. All the income he makes, whether it's through Venmo, PayPal, Cash App, whatever you guys use, you're going to have your top line gross revenue come on there. You're going to show your deductions, and then you're going to have a net profit. Now I'm going to get into those a little more in detail, but the thing that I want you to take away from a Schedule C is it's what sole proprietors use. So, if you have an LLC or an S-Corp or things like that, we're going to go over that a little bit later. But the main thing for you guys to know is to file a Schedule C. something I get asked a lot is, what is the best form of payment and what is the best form of accounting that I can do for my business? So it does get difficult when it comes to accounting time, depending on how, well organized you are. Do you use Zelle, PayPal, Cash App, all these things, or do you just use one in order to make it a little simpler? The first thing that I highly recommend that you guys should even do, honestly, today, tomorrow, you could do it, is get a bank account from any of the big four, Wells Fargo, Chase, whatever. I personally like Chase. Get a bank account, and anything that has to do with personal training, you put it in that bank account. Whatever you do, I just implore you not to mix your personal with your business. And this is going to become more apparent as you get bigger and as your income grows. Because in the IRS's eyes and in the law's eyes, you guys each have a business now. So you have to be on top of your accounting and your taxes and stuff like that. You're no longer an employee who gets their tax withheld. So I implore you to create a bank account, and from there, put in maybe $10,000, $15,000, whatever it is, and you can actually create a Zelle or a Venmo that is directly linked to that bank account. So everything that you make income-wise goes into there. And then you get a debit card that is also linked to that, and any expenses that you have will come from that account as well. So now comes one of the biggest questions that I get asked, and Adam says a lot of trainers ask, is deductions. What does that mean, right? So not to get too fancy, but there's a specific section that the law has that says all the expenses that are related to your business, in order for them to be a write-off, meaning in order for them to be taken against your income, it has to be ordinary and necessary. So all that is to say, the expense needs to ordinarily happen in your line of work. We'll get to that. And is it a necessity? Is it required for you in order to do your job? So those are the two things that we always have to think about as we are deducting. Say what the biggest deduction is going to be for independent contractor personal trainers for you guys. Like, what do you think is going to be the largest one on here? Exactly. So the rent that you guys pay Adam and Self-Made is going to be the largest expense that you're going to be showing on the Schedule C. So
not within a year. After a year, your biggest expense should be your marketing. That's how you're going to make money. You really want to break the 6 figures, your biggest expense in a month needs to be the marketing. And a month or a year. So let's say, for instance, your rent is $450. If you're trying to break like 10K to 15K, you have to boost and buy ads and stuff like that. It's going to be more than $1,000.
yeah.
You really think about it, if you're making 10K a month, that's like less than 10% in marketing. Most businesses is 50% in marketing. Yeah, so like when you're getting to the, it goes in brackets. But let's say, for instance, you boost a couple, $20, $100, anything here and there, it's usually about 10%. Yeah, I mean, even 10%, 20% in marketing is perfectly fine.
Excellent. Nobody knows about you. You have to get yourself out there, right? And I keep going back to the reel that Benny got famous off of. That's how you're going to get yourself out there. Maybe he's going to pay more to Instagram to actually get that to even more eyes, more people to know about Self-Made and his brand. So, I like to open this up to, ask you guys, what do you want to know? What kind of write-offs do you think are ordinary and necessary? And, I want you guys to kind of start thinking about what kind of things you can deduct off of your gross income to bring down your profit. So, what are some expenses that you guys have?
Transportation.
Okay, we're going to write that one because that has some special rules related to it. Yeah. Auto.
attire/uniform.
Okay. Let's get the black one over here. Uniform. Are you guys actually told what to wear here? Yeah, so this doesn't count. Advertising, definitely. Anything that you pay for on Instagram, again, I completely agree with Adam. Advertising should be your biggest expense. People need to know who you are, get your name out there, and that's going to come right off of your Schedule C. Oh, you first.
Yeah. Two. I didn't realize it. That's two questions. One, uniform is like, even for like buying like apparel, like clothes, like our own. I realize that's not happens.
So this is going to be a big no. The personal expenses, such as makeup and hair care, your clothing, your haircuts, stuff like that, the IRS has ruled multiple times, tax court has ruled multiple times that anything personal is not deductible. So we have something in the biz called hobby loss, okay? A hobby loss. So this is exactly what the idea of economic value is. You guys are personal trainers. You know, in order for you to live, you have to make money, obviously. So when you have zero or even negative, because you can have negative if your expenses exceed your income, for about 3 years, it's okay. But the IRS then looks at you and says, how is Benny surviving? How can he be living without making any money? So then you fall under something that they're going to start scrutinizing called hobby loss rules. So now they look at your business and say, this is not a business. This is a hobby. This is not a real business. You don't have any accounting records. You've never made money in these past years. Where is your actual full-fledged business? So this has like 30 different stipulations. I don't want to get into that, but then it becomes a hobby. So cool. Now, a deduction that I want to talk about that a lot of people don't understand is the IRA deduction. And this goes into investing. So I'm not a financial advisor. I can't give investing advice, but as a tax advisor, I'm able to tell you what kind of 4 AGI adjustments, they're called, allow you to lessen your income that are not on your Schedule C. And the biggest one for independent contractors like you guys are going to be your IRA. So an IRA is an account that you open with a brokerage, which is an investment firm, that you take your hard-earned dollars from a business and you invest in the stock market, you invest in real estate, you invest in a fund, something like that. And what happens is you get to put in up to $7,000 into that account and have that come right off your top line, which is the gross revenue of the Schedule C. So it's immediately $7,000. So the law incentivizes taxpayers and us citizens to invest for our future. So they want you to do that. So there's no stipulations around this. It's not subject to any kind of limitation. So you could take a traditional IRA, put in $7,000, and get that right off right there. A lot of people think that you just go to Schwab, create an IRA account, and just put money in it. No, this money has to be invested. It has to be invested in something. A traditional IRA is just the name of the account. So you have to get an advisor, I suggest. You could do it yourself, but something called an exchange-traded fund, for example, a mutual fund, something that this money that you're putting in is working for you. Because at the end of the day, I was talking to Raul about this actually, you don't want to work for money at some point in time. You want your money to work for you, right? Because how long are you going to be able to do this for? My knees are already given out. I'm 30 years old. 35? You need a good chunk of change. There you go. So automating your investments. You can take the 7,000 divided by 12 every month in order for you to budget as well, which we'll get into at the end. You will have your investments on autopilot. So if you invest early and often, you're going to have a good future ahead. So that is that about the IRAs. The next thing I want to talk about is SE tax, self-employment tax. Oh boy, when I tell you guys this, you guys are going to probably say, I hate taxes, I hate tax law, they're taking so much money from me. So this is where the LLC S Corp comes in. Okay, so you have the gross income that you make from your business, from yourself, your personal training. You have all of your expenses, and then you get to your profit, your net profit. As a Schedule C, you're subject to 2 taxes, not just 1, 2. This is going to be, you have your income tax, obviously, and then you have your SE tax, your self-employment tax. All earned income in America, active earned income, is taxed with these 2 taxes. So I'm going to explain what that means by giving a comparison of when you were an employee. So I work at McDonald's. I make $100 a month. That's my gross revenue. That's what they're paying me. What do I actually get, guys, at the end of that? What's my net? I have income taxes taken out. I have Social Security taken out. I have Medicare taken out. I'm not done. I have state taxes taken out. And because we live in California, we have an extra tax called I hit it, state disability insurance tax. So all of those things are taken out before my $100 becomes $5. So because you worked for that money at McDonald's, it's earned income. So it's subject to both income tax and self-employment tax. LLC versus S Corp. Okay, man, I know that Raul really wants to know about this. So, the LLC versus the S Corp. I actually first want to ask, what does LLC stand for? Because why not know what it means? So it's limited liability company.
Company.
Yeah, because it's not a corporation.
Yeah, company.
Yeah.
Like I said,
Company.
She did say something.
She actually, like Benny, I heard it. So an LLC, limited liability company, is an entity that you create with the state, the Secretary of State, that now formalizes your business. Now, just like we talked about before, why have an LLC and S Corp when we have a Schedule C? We're already a business. What do I need these for, right? So the IRS created this sole proprietor Schedule C because they know that a lot of people work as independent contractors and don't have the resources to go ahead and formalize their business. But a lot of people don't need these, and I'm going to get to that right now. Don't need an LLC or S Corp. An LLC is an S Corp. It's recommended that your net, once your net reaches around the 50,000 mark, then we suggest you go ahead and create an LLC. So just to recap, what does net mean? What is net profit? What is the definition of that? Well, gross expenses, net profit, right? So you have your gross income minus all your expenses is your net profit or profit. So once your net from your business is 50K around there, then we suggest create an LLC. Creating an LLC comes with so many stipulations, it's not even funny. Because now you're a full-fledged business in the eyes of the law. You need to be keeping track of all your income and expenses, accounting-wise, doing bookkeeping. What is bookkeeping? Just categorizing all your expenses. And you now have separate filing obligations when it comes to state and federal. So when we get to Schedule C land with an LLC, so actually, so when you're a one-person LLC, just like you are, right? In tax law, a one-person LLC is automatically taxed as a Schedule C. So, because there's no more than one shareholder or partner or anything, so to make it easy on the taxpayer, you just file that LLC under the Schedule C. But what you've done for yourself is you've added extra liability protection. So that's besides the tax the ramifications or tax advantages, the LLC creates the liability protection should you be sued for negligence. So whatever you have in this LLC is what can be touched should you get sued. So if I slip and fall here, I mean, you guys also have your liability insurance that you pay, but this adds an extra layer. So no personal assets can be touched. That's the beauty of these legal structures. Unless it's fraud. The government couldn't go in and, unless it's fraud. But you have personal protection from your personal cash, your home, your trusts, your kids. These things are now protected because you have an entity. So, the LLC with one member taxed as a Schedule C is still subject to the same tax, income tax and self-employment that we talked about before. So it actually doesn't help you at all when it comes to taxes. And I get this question literally every day. Sam, I created an LLC. I'm untouchable now. Like, I can deduct everything, pay zero in taxes. No, who said that? I think a good attorney probably sold you on creating that entity. Legally is different than tax-wise. That's the thing that we have to think about, right? So you're protected, but tax-wise, you're going to be taxed the exact same way. So that means your LLC at the end of the year, your net income is going to be both taxed on self-employment and income tax. We are the most aggressive state of all 50 states. If your address, if you live, breathe, eat, work, have your driver's license here, it doesn't matter where your LLC was created. And that's actually an excellent question. If you create your entity in Nevada, which is a no-tax state, Texas, Florida, whatever, it doesn't matter. You have to do what's called qualifying your entity in California, because you need specific numbers in order to file your returns. You can't do business if you don't have what's called the right to transact in California. So they have these rules. They know people are doing that. A lot of people do get away with that, but believe it or not, just last week, I got a letter from the Franchise Tax Board from someone who did just that. I mean, I see it all the time. But one of my clients, long time ago, had a Nevada LLC, and they finally figured out this person has been doing business, I don't know why it took them so long, that they're doing business in California. They have to pay taxes on so many back tax years. That's a big burden, guys. It's not worth it because we are very aggressive here. California is extremely aggressive. And I always laugh. You guys think the IRS is bad? Literally no comparison to California's tax. Literally nowhere. Like California, it's called the FTB. Yeah, they're very difficult to handle. They're almost like the mafia, I hate to say it. We got letters in the past couple weeks that said, the Schedule C that you filed in 2019, it had this specific marketing expense on it. We just want you to make sure that you have the support for it. It was the first time that the industry has seen a letter that doesn't tell us to take action specifically to give them something, but to be on the lookout. That's like the mafia right there. They're telling you, it's a threat letter. So they're becoming very, very, it's very dangerous. It's kind of scary. And that's because a lot of people are leaving California, guys. they want to make sure the base that it is here, they're collecting every last cent for the base that we have in order to pay for the bus system or anything that we have for social services. So, yeah. An LLC is an entity that you create with the state. An S Corp is simply a tax election. And I think that's probably the most important thing to take from this. So an S Corp is a tax election. What does that mean? That means I file a specific document that tells the IRS and state that you want your LLC to be taxed as an S corporation. You don't go to the state and create an entity called an S corporation. It's simply an election from an LLC. Now, in the personal training industry, you guys are allowed to have LLCs, but someone like me in California, I'm not allowed. Engineers, physicians, certain trades are not allowed to create LLCs, which is kind of scary. They don't want us to have, I guess, as much leeway as, because an LLC gives you a lot of leeway when it comes to taxes and accounting. They want us to formalize and become a regular corporation. I'm not allowed to be an LLC. So I can be a regular corporation, which is an entity that I create with the state and then can tax as an S corporation. Or for you guys, you can be an LLC, tax as an S corp. So again, an S corp is an election, meaning the LLC or regular corp, the type of business that I have, these both go and then they file something so they can be taxed as an S corporation. Now, we want to know what actually is an S corporation. An S corporation, it has an S because it comes from subchapter S of the code. Don't need to worry about that. But remember that pesky 15.3% that we talked about? So who remembers what the name of this tax is called? See in your notes. What is this 15.3? This is the self-employment tax. So this is the biggest strategy. It's like I'm like TikTok now that I'm giving away for free right now. So this is what you're going to hear everybody talk about. This is the biggest strategy. When you create an LLC and you tax it as an S corp, only certain portion of your profits are subject to self-employment tax, not the entire lot, like it was when you were a Schedule C sole proprietor. Now you're like, then why doesn't everybody do that, right? So that's because you're formalized now. You have to make sure that you even reach the level of income that it makes sense to be a corporation. And you have to realize now you're obligated to keep your bookkeeping in check, and the IRS needs you to be substantial and on top of your business as much as you can. Like you are now it's a lot more stringent now. You have to treat it like you're the CEO of a company because you are the CEO of your company now. So that's one way to look at it.
What's the range?
So for both of these, again, it's $50,000 net, but to be taxed this way, so it's not 100% of your profits, but now that we're an S corp, you have extra things that you have to do now. And the biggest thing is you are an employee of the corporation. Thank you.